The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive deep into the uncharted territories of niche investment strategies that promise to redefine wealth. I'm Nadiah Koh. A growing number of young investors in Singapore are reshaping the investment landscape. According to a recent Morgan Stanley survey, nearly 70% of Gen Z and millennial investors globally dedicate more than 20% of their portfolios to companies or funds that demonstrate strong corporate values. This trend highlights a broader generational shift, with younger investors increasingly prioritizing sustainability, technology, and innovation when making financial decisions. However, aligning investments with personal values also present unique challenges. Young investors tend to have higher exposure to speculative assets, greater risk tolerance, and herd mentality. These factors can give rise to behavioral pitfalls such as the fear of missing out and herd mentality. So how can young Singaporean investors navigate the balance between values-driven choices and long-term financial discipline? To find out more, joining me now is Lim Zeyu, Wealth Manager at Phillip Securities. Hi Zeyu, welcome to the show.
Hi Nadia, thanks for having me today.
Thank you for joining us. So Zeyu, what are the key factors driving Gen Z and millennial investors to increasingly prioritize values-driven investing?
Right, so I believe due to the increasing exposure we have to global news and issues, younger investors are becoming a little more conscious about issues like climate change and societal issues. And this has kind of shaped the mindset where many of them prefer their money to support causes that they care about rather than just focusing solely on financial returns. So in fact, another survey in 2022 by Amundi and the Business Times found that around 80% of Gen Z investors in Singapore are interested in investing in line with their values. And around the same percentage said that this has become more important compared to before the pandemic. And I also believe it is much easier now to read up on news across the world so they can make better decisions and confidently choose investments that align with their principles. Like, for example, there are more asset management firms. When they release their fund fact sheets, they also include ESG metrics. And that makes it so much easier for younger investors to assess how sustainable the underlying companies are.
Okay, so how does this generational shift compare with older investor cohorts in Singapore and globally?
Oh, right. Definitely there's quite a difference. So I believe in Singapore, younger investors place quite a stronger emphasis on values-driven investing as compared to the older cohorts. So while older investors often prioritize long-term wealth accumulation, retirement planning, the younger ones are more likely to weigh the social or ethical impacts of their investments, alongside the financial returns. To them, it's not just about growing their money. I think they also want their investments to sort of reflect their principles, which marks quite a clear shift in the mindset. Globally, I think the pattern is quite similar, although the pace and intensity will vary by the market. For example, markets where social and environmental awareness is higher, I think the younger ones would drive to move towards values-aligned strategies, while the older investors tend to stick with more traditional and performance-based portfolios. And I think it also can be seen by the fact that the technology and easy access to information makes it simple for the younger investors to research and act on their values, which further differentiates them from the older cohorts.
Right. Earlier on, we spoke about the FOMO, or the fear of missing out, and also herd mentality. How do you think these behavioral tendencies manifest among young investors?
Definitely a trend observed among younger investors. I think even among my peers as well. And I think this is also the slight disadvantage of having access to too much information too easily. Younger investors are quite susceptible to FOMO, or as you said, the fear of missing out, because they are still early in their investing journey and perhaps may have not developed the habits to actually assess the risk objectively. And in fact, if I may add, I think social media also does amplify this effect. And maybe we have heard of platforms like Reddit's Wall Street Bets, where they discuss high-risk trades and trending stocks. Yes, I mean, some people will say that, you get more information, but I feel it can also expose these younger investors to coordinated buying activity and then create a sense of urgency for them to act quickly. So, the temptation to blindly follow the crowd might be there. So, younger investors definitely have to balance the buzz with careful analysis from their side.
Right, but why are social media platforms so easy to influence financial decisions for younger generations?
I think it's quite attractive as younger investors to be able to access all this information online. Right? So beyond like Reddit, I think even now X or what was Twitter, and those online forums also allow them to discover new opportunities, right? And also to see how their peers online approach different sectors or different teams. And I feel it also provides them a sense of community and engagement. So if you're able to share your ideas and learn from others online, it really allows young investors to learn from one another and maybe refine their thinking. But if I also may add, I feel that what I observe is that sometimes the news overload can also cause younger investors to be quite emotional if they're investing. They often say that news headlines sometimes thrive on fear-mongering, and I find that to be true and also quite unfortunate for the young investors. So, end of the day, it might disrupt the long-term big picture that they should keep in mind, right? And this bad practice might lower their overall returns.
Okay, so based on your observation, are there any particular behavioral pitfalls that are more prevalent among values-driven investors?
Right. I think the first would be over-concentration, which is when investors put too much of their portfolio into maybe a single team or a single sector just because it aligns with their principles. And yes, while it may feel good to support the causes that they care about, it can also expose the younger investors, the value-driven ones, to higher volatility and maybe even sector-specific risks. Another pitfall, I feel, is letting your personal beliefs override objective analysis. For example, you might choose to stay invested in a particular company championing, say, maybe some eco-friendly solutions, even if the company's fundamentals are objectively weakening, just because, it aligns with their values. So be careful of confirmation bias, I would say. Recognizing these tendencies and patterns early can help young investors to pause and balance their enthusiasm with a certain amount of discipline and objectivity. Yeah.
Right. So we're seeing younger investors combining value-based investing with higher risk tolerance and speculative asset exposure. Are younger investors adequately considering risk management and diversification in their portfolios?
Oh, definitely challenging to pursue values-driven investments alongside more speculative assets. I think this may appeal to younger investors because they align with the principles, but as you say, it comes with higher volatility and uncertainty. So without such careful attention, it can be easy for their portfolios to be overexposed to maybe a narrow set of investments, right? And that increases the potential for significant swings in the portfolio value. I think many of the younger investors are still trying to learn how to strike the balance. So in the meantime, they might tend to gravitate towards certain high conviction and high risk positions without, really diversifying across sectors or even multiple asset classes. So I think, they should probably set some limits on how exposed they are to these sectors or perhaps even individual stocks so as to spread out the risk, be it geographically or sector-wise.
Okay, so how can investors critically evaluate thematic investment opportunities to avoid over-concentration?
I think it goes back to the basics of having an overarching view of your entire portfolio. So by doing so, it could mean examining the kind of exposure you have, which sectors are quite heavy in your portfolio, and maybe even which geographical regions. So, for example, maybe if you're only having climate-related investments in one sector, it could leave your portfolio quite exposed if that sector happens to have a downturn. And I feel when you're looking to onboard new teams into the portfolio, they should definitely examine how that specific team fits within what they currently have, so that you don't have too much overlapping with your existing holdings. And so I think a thoughtful mix of thematic and broader market exposure to the traditional investments could be a good balance between your personal conviction and proper risk management.
Okay, so what practical strategies can help young investors align their personal values with disciplined portfolio construction?
I think the first would probably be to identify and clarify your priorities. For example, one can have many values that they want to infuse into their investments, but it might not be ideal to implement them all at the start. So perhaps identify which causes or principles matter most to them, and then integrate them into an already diversified portfolio. Sure, it might be nice to allocate a portion of the investments to companies or sectors that align with the values, but I think it's also important to keep in mind to keep the rest in broad market or income-generating assets to manage the risk. And perhaps the second would be to take a more gradual approach to values-driven investing, like don't get too excited. Instead of committing too large a sum into one theme, I think investors can start small and then increase the exposure over time. And of course, as always, we always advocate for regular portfolio reviews. So, anywhere between once to twice a year. And this helps to ensure that your personal convictions do not dominate the portfolio or create unintended concentration.
Right. How else can financial advisors support younger investors in managing behavioral risk and achieving sustainable growth?
Oh, good question. So I think financial advisors do play a key role, especially to navigate the emotional side of investing. And as we mentioned previously, young investors, they can face issues like FOMO or being swayed by market hype. So that can lead to quite impulsive decisions. And where financial advisors can come in is by encouraging them to stick to their long-term strategy and avoiding chasing short-term trends. So for example, just to remind the clients of their clear goals, assessing their risk tolerance, and then sticking to the structured plan that was perhaps planned prior to their journey. I think another way that advisors can come in is to act as a sounding board for investment ideas. So help them to really assess the opportunities that come about and making sure that the clients are not too concentrated on one particular aspect. So, advisors, I think they do come in to also check in regularly and review the portfolio together with the client. So acting as a sort of check and balance, and reinforcing some sort of discipline in the investing.
Right. And finally, before we let you go, how do you see values-driven investing evolving among Singapore's young investors in the next few years? What trends or developments should investors and advisors be watching closely in this space?
I feel values-driven investing will probably be here to stay, and I believe it's so set to continue growing as more of them seek opportunities that reflect their principles alongside financial returns. And I also believe it's because there's a greater awareness of sustainable practices. And a recent survey last year by YouGov and Fidelity International found that within Asia Pacific, about 68% of Gen Z investors consider sustainable investing to be quite important, and around half of them actively engage in such investments. So definitely there's some sort of generational shift towards more conscious investing where purpose and performance are considered together. So looking ahead, I feel that investors and advisors should watch developments such as government initiatives that promote sustainable finance. For example, I think there's one Singapore Asia Taxonomy which helps to make it easier to identify opportunities aligned with broader societal goals. And additionally, with the increasing availability of digital tools and platforms, younger investors are better able to access information, track the trends, and engage with such thematic investments more effectively.
All right, some great insights there. Thank you, Zeyu.
Thank you, Nadia.
Thank you. That was Lim Zeyu, Wealth Manager at Phillip Securities. This has been the Wealth Tracker with me, Nadiah Koh.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.